Starting to see some participants arrive, huh? We'll get started in a moment here. I'd like to see a few faces. Hi there, Corey. Welcome back. How you doing?
Hi, I'm doing good. How are you?
I'm glad we can hear each other, huh? You keeping up with the class so far?
So far, yeah, I'm about halfway into chapter 2 and I have some questions, so
All right.
I'm
Actually, we're
ready.
going to go over chapter 2 and 3 according to the schedule, so we'll have a little busy
Awesome.
session here. I see we have 6 participants. Who else is with us here? Corey, Dominic, is it? Hi, Dominic. Can you hear me?
Yes, hi.
Luciana, can you hear me? Need to
Hi,
unmute
yes, I
yourself.
can.
Okay, and Robert, you're with us, Robert?
Hello.
Okay, I guess we'll get started. I almost had a panic attack trying to get into this meeting. The system didn't want to work at first. So let me fix this here. Just hold on. Gotta fix that. Don't want that. Okay. All right, here we go. I'm just having a little trouble getting this thing to. Bear with me, please. What I'm trying to do is get this thing in full screen mode, and it's not letting me do it. And that's going to make it hard to share the screen here. In fact, I won't be able to share the screen until I figure this out. Thank God. I think I have it now. Okay. Thank you. Thank you. I'm sure my boss is going to want me to trim this first part of the meeting. Okay, here we go. If there's a God in heaven, here we go. Do you see the PowerPoint there, everybody? Okay, I'm going to try to make it just a little bit bigger for my older eyes here. Okay, here we go. We're going to go into chapters 2 and 3. In chapter 2, we're going to lay some more of the groundwork. And then in chapter 3, we're going to get our first look at debits and credits, I believe. Okay. So in chapter 1, we talked about the different financial statements, the income statement, statement of equity, and the balance sheet. Here we're going to get into a few transactions. In this class here, we are right now talking about what are called external transactions, meaning they're with an outside party. There are 2 people involved, one of whom has nothing to do with our business, but we buy from them, we sell to them. Perhaps we're paying the electric bill. External. And that's going to become important later when we get to adjusting journal entries, which are internal type entries. So external, internal. And what we have here is a fancy slide that I think I'm actually going to skip because I don't particularly like that slide, okay? So in our chart of accounts, we have the accounts listed in order by assets, liabilities, equity, revenues, and expenses. And the assets are listed in liquidity order, meaning which is the easiest to turn into cash. Cash goes first, accounts receivable may be next. So think of these folders here as a pocket where you're going to record your transactions for that particular item and keep the balance going forward. So we're talking about a balance sheet. A balance sheet. The balance sheet is a representation exactly of the accounting equation. The accounting equation we can never forget, right? Assets equal liabilities plus equity. If I have $5 million worth of assets and I show them to you, here it is, $5 million in cash. I'll give you this cash for $100. Would you do it? Well, you might not if you find out that I have $6 million in liability and the business is really worthless. The point is, an asset is anything of value the company owns. You subtract the liabilities, meaning what you owe, and what's left over is your stockholders' equity. Liabilities are an IOU, they're a debt, they're payables. The income statement, sales minus expenses, like we did in chapter 1. Sales, fees perhaps, interest revenue, rent, you can have all kinds of different things. We have the normal expenses, salaries and wages, rent, depreciation, advertising. I'm going to call your attention to cost of goods sold. You're going to be hearing this one throughout the course. Cost of goods sold is simply what you paid for the item you just sold. Cost of goods sold is recorded at the point of sale. In this book, we are Nordstrom's, we are Macy's, we're like a big department store. Merchandising, we're buying something and selling it. We sold a garment for $500. We paid $200 for that from the clothier. That $200 is your cost of goods sold. That's what that expense is. Every transaction hits 2 accounts. Every transaction requires 2 accounts. It's going to require a debit and a credit when we get the debits and credits, okay? Assets equal liabilities plus equity. I can't say that enough. And of course, the accounting equation must always be in balance, must remain in balance at all times. That used to be a problem in the Stone Age when we had to do this stuff with pencil. With accounting software now, I doubt any system could possibly allow you to go out of balance, but it must remain in balance. So let's just keep that in mind, huh? In these next 2 chapters, we're looking at some actual data, excuse me, from Papa John's. Papa John's, here's part of their balance sheet, huh? Cash, and these are actual numbers, probably rounded. They're in thousands, so they have $13 million in cash. Notes receivable, 12. Notes receivable, what that means, it's not accounts receivable now. Accounts receivable is the debt owed to you by customers, people to whom you sold things. Notes receivable simply means you loaned money to somebody and they owe you. And the equipment and assets, so their total assets are $380. And the liabilities, note payable and others, come to $232. And they have an equity section here with 2 components. And when you add those 2 up, they come back to the $380, okay? Your stockholders' equity has 2 components to start for this class right now. Contributed capital, which is the monies that the company raised either by issuing stock or borrowing, or perhaps the entrepreneurs put their own money in at the beginning. Retained earnings is 0 the first day of the business's existence. But at the end of each month, as they prepare their financial statements, if they made a profit of $5,000, equity would go up by that $5,000 through the component called retained earnings. It retains all the earnings. Another way to say it, that $84,000 you see there represents the total income Papa John's has had since it sold its first cannoli, okay? As we say back in Jersey, cannolis are popular, okay? That's assuming there's no dividends. So let's just look at a couple transactions. This chapter we're going to go through, it's a shorter chapter, and then we get into some real guts later on, okay? Let's analyze and see what happens to our accounting equation. Oh, good. We're getting into journal entries right now, huh? Journal entries. journal entries. Let me just see one thing here real quick. I'm just going to go back up to the top very, very quickly. Not as quick as I thought, but I want to go back up there. Come on. Okay. I really wanted to double check something there. Okay. So here we go. We're going to learn about T accounts and journal entries. A T account looks like a T, huh? Hence the number, huh? And journal entries. The T account mimics your general ledger. It's the poor man's general ledger. A T account is actually just a piece of scrap paper. It's a way to organize the data so that you can put it into the journal entry, which is the mechanism for updating the general ledger. So a couple of rules now. The T account, you're going to have one for every one of those folders. You'll have one for cash. You'll have one for notes receivable, wages, expense, etc. The left side is the debit side, and the right side is the credit side. That's all debit and credit means. It just means left or right. It does not mean up and down, increase, decrease, more or less, good or bad. There's no value judgments here as we go along. Hopefully, this will start to click. Debit means left, credit means right. That's all it means. That's all. Now, here's where we get into which items are affected how. Debits and credits affect the balance sheet like this. Assets equal liabilities plus equity. Note assets. Assets are increased with a debit. Increased with a debit. So if you borrowed money from somebody, your entry is to increase cash, and that would be done with a number on the left side, the debit side. The normal balance for cash is the debit side. Debit is the side of the account that increases it. So I just said we borrowed money, huh? So the asset went up with a debit, but the liability, we owe that money now, right? Because we borrowed it. The liability account, let's call it notes payable, that went up with a credit. How about that? Any transaction, the debits must equal the credits, and you must have at least one debit and one credit. You can have one debit and 50 credits as long as they equal. You're going to struggle a little bit. Those of you who didn't take 110 at least, you are going to have to just learn these rules. Assets have a debit balance. Therefore, liabilities and equity have to have a credit balance. Otherwise, this thing would not equal itself. Assets increased on the debit side, liabilities and equity on the credit side. So we get a transaction, and we're going to have to think in terms of what accounts are affected. For example, you're at your desk, you open up the mail, and here's the electric bill. Well, you know you have to do something with that, huh? What accounts are affected? Guess what? Electricity expense, if you've got that in a separate chart of accounts item, or perhaps utilities expense, if you include all your gas, electric in one. So you know that it's going to be telephone expense, and you're not going to pay it right now. Probably pay it in 2 or 3 weeks. So that would probably go into accounts payable. What type of accounts? In my example here, it's going to be an expense and a liability. What goes up or down? What are the rules? Here we go. So let's look at some accounts here in chapter 2, okay? Before transactions are posted to the general ledger, they are put into what we call the general journal. In our course here, every transaction takes place in the form of a journal entry. So what I'm looking at here is a journal entry. And I see cash, contributed capital, I see debit, credit. So let's take a look at this. A journal entry is going to have a date. Definitely is going to have a date. You could have a reference number, another column here if you wish for a reference number. You're going to put the account title, which ones you're affecting. You're going to start with the debits if you can. It's not a hard and fast rule, but that's the expectation, okay? That's the expectation. You put the debits here. Notice that the credit is indented. That is very important. That's the accounting convention in terms of presentation. It breaks up the look of the journal entry, makes it a little bit easier to figure out what's debited, what's credited, just by looking at this column. If you don't indent it, it doesn't affect the accuracy, but you're going to demonstrate to the world either that you don't know what you're doing or you don't care. You need to indent your credits. And you put the dollars here. Debit, credit. At that point, we've done nothing. All we've done is put this in your computer system. We now have to go to the step that puts it into the general ledger, and that's called posting. We're going to post it at the end. We're going to post all our journal entries at one time. So they're showing this entry in the form of this journal form here. It's the same thing. Like I said, they could give you another reference if you wanted. We're looking at the same thing. Here, at least, they're telling us what the transaction is for the first time. Papa John issues $2,000 of common stock. That's really $2 million. What they did was they sold stock to the public, and it brought in $2 million, okay? So look at your T accounts. Look at what they look like. When we wrote this journal entry, nothing happened until we hit the button that says post. And when you tell QuickBooks or Oracle or whatever your system is to post, it updates the general ledger. The general ledger, that's the books, huh? Think of these T accounts right now as your general ledger. And we're going to be looking at the general ledger shortly, but here we go. This company at the beginning of the month had $6,000 in cash. They issued stock worth $2,000 more. So after that transaction, the cash balance is $8,000. The business had equity of $1 million at the beginning, and now it's gone up to $3 million. So the journal entry, you hit post, here is your general ledger. We borrowed money from the local bank. Wow, that's the example I just came up with, huh? Signing a 3-year note. That means the money obviously is going to be paid 3 years from today. And with a note, there's going to be interest expense. There's going to be a written contract signed by both parties. And it's unlike accounts payable, which is on faith, okay? Let's take a look here. We borrowed $6,000. We prepare this journal entry. Let's see. We go through our thinking process. We borrowed money. What did we borrow, huh? We borrowed cash. Cash has to be increased with the debit as we learn our rules, debits and credits. Notes payable is a liability. It has a normal credit balance. I'm going to repeat what a normal credit balance is. A normal balance is the side of the T account that increases it. You should always see a debit balance in cash. If you see a credit balance in cash, there's something wrong. You can't have negative cash. It means somebody made a mistake, there's a missing transaction, or you're playing the float the check game, which many of us have had to do in the workforce. Here's another one. Here they're introducing us to a journal entry with 3 lines. A journal entry could have hundreds of lines. When I worked as the CFO at the Santa Barbara neighborhood clinics, we had all kinds of a payroll entry that was like 200 lines long, but the debits equaled the credits. So here, let's go over this one. Company purchased equipment that's worth $10,000. They had to put 20% down, huh? and they signed a note payable for the rest. So what happened here? Property and equipment went up with a debit. Cash went down 2,000. Notes payable went up 8,000. You good with that, Maria? Okay, how you doing? Okay. The company is now lending money to its franchisees, huh? And they sign notes. So now we're not borrowing, we're lending. Well, what did we lend? Obviously, we lended, is that the word? We loaned cash. So cash has to be credited. That reduces our cash balance, but notes receivable went up, which is also an asset. So we are debiting an asset and crediting another asset. We just exchanged assets. We purchased stock in another company. Papa John's is making money, huh? Their business is making pizza. They're selling those pizzas and strombolis and cannolis, and they've got a lot of cash lying around. So they decide to buy $1,000 worth of Microsoft stock. Microsoft. So they bought some stock in another company. That's an asset. And they used cash to buy it. That's another asset. Debits equal credits. Again, just an exchange of two assets. Called the switch. Wow, they declared dividends. That's nice. If you own stock in Papa John's, you're going to get a dividend. I don't know how much it is per share, but the total they're giving out is $3,000. On this journal entry, I want to emphasize something. All dividends, whether they're a cash dividend or a stock dividend, will require a debit to retained earnings. A dividend is the choice of the company to give away part of its equity to somebody else. When you purchased 100 shares of Papa John's, you get this dividend. They've given away part of the company. So all dividends reduce equity with a debit, and at the time they declare, they owe you that money. That becomes a liability. Liability. So we just went through a few transactions here, and we're going to go into chapter 3 after this, get a little more detailed. Balance sheet. You can prepare a balance sheet anytime you want. You typically do it at month end. You know, companies don't necessarily look at financial statements during the month. I mean, they're monitoring how they're doing, but they're not doing statements every week, probably. The balance sheet. And here's another look at their balance sheet at a different point in time, I guess, huh? Again, it's in thousands. So at this time, they had 15 million in cash. Assets equal liabilities plus equity, okay? Liabilities, notes payable, money we borrowed that must be paid back. Notes payable is a written contract with all kinds of stipulations and interest rates and penalties. Accounts payable, there's no written contract necessarily. And you're going to get involved with these ratios as we go forward, okay? And I'm going to introduce this one quickly. Where you're going to do these is on your FSAs, okay? And I'll let you know what two companies we're going to do. I usually do Coca-Cola and Pepsi, or General Mills and Kellogg's, companies like that. So we'll see. It'll be a consumer company that you're familiar with, two of them. If you take your average assets divided by average equity, you get a number. In this case, you get $2.37. And what that means is that for every dollar of assets they have, they've got, for every dollar of equity, rather, they've got $2.37 worth of assets. I'm going to skip the ratios a little bit. Chapter 2, that was a real brief look, okay? Let's get into some meat now. You ready for some meat? I'm a carnivore, so let's see what we have here. Come here, meat. Okay. And I'm going to ask the stupidest question in the history of the world. You did see all those slides, right, as I was going through this?
Yes.
Yes.
I did.
The reason I ask is in Monday's class, 110, I was zipping through these slides, and 5 minutes in, I realized people were blank. I had forgotten to share the screen. So I'm glad you saw the slides. Huh? All right, chapter 3.
I hear something saying this meeting is being recorded.
What's that?
I hear a voice saying this meeting is being recorded about every minute or so.
The meeting is being recorded. You know that, right? The
Yeah,
meeting's being,
it feels to be meeting.
yeah. And of course, this I give it to Cornelia, and sometimes she looks it over and she gets back to me and says, "No, it was a lousy lesson. Substitute something." But she usually says it's okay. She usually wants me to trim a little bit. Like right now, we're getting off course. Cornelia may say, "Trim these 2 minutes here," but okay. This the business cycle, huh? We start a business, we put money in, and what do? We buy things and we pay for things. We get payments from customers. So the cycle might be we get our business going, we buy our product, we pay for the products, we sell, deliver the products, we receive the cash, goes on and on. Not too tough, huh? How are financial statements prepared? This is a little bit of a repeat of chapter 1, but you'll be doing a lot of this, huh? The income statement must be prepared first. Has to be done first. There's no way of getting around that. It must be done first. The income statement, think of that as a one that I. We're number 1, income statement. The reason we do the income statement first is because we're going to take the revenues minus the expenses and get the net income. That's pretty easy. That allows us to do the second statement, the statement of retained earnings. We're going to have the beginning retained earnings from last month. That goes up now if the company had net income. Hopefully we did. If any dividends were declared, that reduces your equity, like we just discussed. And now you've come up to the ending retained earnings. Once you have the ending retained earnings, you can now add that to your stockholders' equity down here. So that sequence of statements is non-negotiable. We're not going to worry about the cash flow statements now, other than operating, investing, and financing activities. Be familiar with them. Operating is the core business. Coca-Cola makes soda, potato chips, things like that. When they sell their product, that's operating. When they pay their vendors, it's operating. Anything that they do to get in the position to make money from soda. If they buy stock in another company, that's investing. If they buy a big giant machine that's going to last for 20 years, investing. And financing is either borrowing or they issued stock, huh? So elements on the income statement. Revenues. These are horrible descriptions. They are just too confusing. Revenues, increases in assets or settlement. The reason I like you to look at this, I'm not going to go over it right now too much, but when you're doing your homework, I noticed they put these clunky multiple choice questions in. Revenues, revenues are sales, expenses. You also have something called gains and losses, and we'll go over that. A gain or a loss are things that affect income, but not operating income. For example, you have sales, then you subtract your cost of goods sold. That'll give you what's called gross margin. I'm getting a little bit ahead. Then you're going to subtract the expenses that relate to the core business and come up with net income. But maybe you made money by selling a fixed asset or something. Maybe you discontinued an operation. Those things have nothing to do with the running of the business and are called gains or losses afterward, huh? So let's take a look at Papa John's statement of income for the end of 2008. You got to update this book, huh? It's 12 years old, huh? Operating revenues. Companies can have tons of different categories, huh? Coca-Cola, if you look at their income statement, I bet they've got a line for sales to New Jersey, sales to, overseas. Papa John's has two. Restaurant sales. You go into their store and you buy some pizza or they deliver it. And the franchise fees. If you want to become a Papa John franchiser or franchisee, you've got to pay for that. So here we go. We have revenues, and they're calling them operating revenues for a reason. Operating. These are the revenues from making pizza. Now they're listing what they're calling the operating expenses, cost of goods sold. In a pizza business, that's the cost of what it took to make a pizza. When you order a 3-topping pizza, the cost of goods sold would be the price of the dough and the pepperoni, etc. Salaries, rent. Total expenses are this number. So revenues are 1,132,000, and keep in mind that's really 1 billion. Hard to believe that there's that many pizzas being sold, huh? So 1,132 is the revenue. Hold on one second here. I got happy fingers, and I think I pushed a button that I should not have. Here we go. Here's where we were. Operating expenses, subtract them. Operating income. Look at the other. The other. Investment income. That could have been a dividend from Microsoft. Interest expense. We borrowed money. That has nothing to do with making pizza. And they had to get rid of some of their restaurants. We subtract that and we get something called income before taxes, if you will, and then they're paying a certain amount of taxes. So they had net income of $37,000 and they had X amount of shares outstanding. They earned $1.32 per share. I just want to see if these are the same numbers. I think they are. Okay. So this is pretty much the same presentation, but they're just giving you some arrows to kind of simplify it. We know what the revenues are. Cost of sales. This is the inventory. In this case, this is the pizza dough, the olive oil, whatever it costs to make that pizza. Salaries and benefits, that's to employees. And these are other expenses that businesses incur. They have to rent perhaps ovens if they don't buy their own. They have to advertise. Papa John's advertises like crazy, right? General and administrative expenses, that's the office people, that's the accounting department, then other. Wow, how many times did we look at this income statement, huh? Same presentation. And they're just showing you the calculation for earnings per share. Net income divided by outstanding shares. Again, you're going to be picking those up in your FSAs. And I hope you like doing the FSAs. I don't know about you, but I'm getting sick of looking at the same income statement time after time, huh? But the thing is, they're just breaking out some different things for us to consider. Corporations are taxable entities, huh? Income tax expense, the income before taxes multiplied by the tax rate. And you might have a federal tax, of course, a state tax, maybe city, depending what state you live in. The operating cycle. We went over this a little bit quickly, but we're going to talk about here are recognition issues. When should revenues be recorded or recognized? When should expenses be recorded and thus recognized, and what amounts? So we're going to go through a few scenarios here and then some transactions, okay? Cash basis of accounting, I'm going to skip this. We don't teach cash basis of accounting here, nor does any other school in the world. But some businesses, simple businesses like cash accounting, it just means that the cash drives all of the revenues and expenses. I'm not going to say any more than that. If you're interested in it, we can talk about it. Accrual accounting, here's what we're talking about, man. Assets, liabilities are recognized when the transaction that impacts them takes place. It does not necessarily have to do with when the cash changed hands. Important to repeat, accrual accounting, expenses and revenues are recorded at the point where the sale is made, regardless of the cash payment, okay? And that is a requirement of GAAP, generally acceptable accounting principles. Acceptable, I always thought it was accepted. Generally accepted accounting principles, GAAP. You just have to know that acronym and understand that there are very strict rules pertaining to how financial transactions are recorded. The revenue principle. The revenue principle. Revenues are recognized when you've delivered the product or performed the service. That's when you record it. It has nothing to do whether you got paid or not yet. And this is silly. There's persuasive evidence you're going to get paid. The price can be determined and you know you're going to collect it. But this first bullet is the one that counts, huh? Delivery has occurred or services have been rendered. Now you have revenue. You can claim to the world, we sold 20 pizzas today. And here they're just giving us some examples of how the cash might come into play. Sometimes the cash does follow the recognition of the revenue. If you get paid at the time of the delivery or at the time of the service, you went out and you delivered some pizzas to the faculty here. You worked for Papa John's, you dropped off 20 pizzas for our party, and we paid you. So you delivered the pizza, that validates the increase in the revenue, which goes up with a credit, and we paid you in cash. It just so happens in that transaction, they occurred at the same time. But suppose you delivered those 20 pizzas to us and you just handed me a bill to be paid later. You still record the revenue, but there's no cash yet. What has happened is Papa John's now has an accounts receivable. Not cash, not as good as cash, but they know we're going to pay for those pizzas probably in a week or so. Okay? And then when we pay Papa John's, they are going to credit the cash. I'm sorry, they're going to debit the cash and credit the accounts receivable when we pay them. Okay? Revenue does not necessarily follow the cash. Assets reflecting revenues earned, huh? Here we go. We're getting into something called unearned revenue. Sometimes customers pay in advance, huh? And nothing has happened. Me, I'm the big sports fan, and the examples I always use is you work for the Los Angeles Dodgers. In February, I send you $12,000 for tickets to the upcoming baseball season. Cash has changed hands, right? But you haven't played any baseball. That is called an unearned revenue. And when you, the Dodgers, get that money, you're going to debit cash to increase it. And you are going to credit a liability account called unearned revenue. You don't know the debt you owe me is not money, it's baseball games, okay? The revenue principle. And here they're showing it. If cash is received before the company delivers the goods or services, that's called unearned revenue. A real good example, in insurance policy. On December 31st, 2019, Papa John's, let's forget Papa John's for a second. Yeah, we'll use Papa John. Papa John's, pretend they're an insurance company. Here's what I'm trying to say. Somebody bought an insurance policy from us, okay? They paid us on December 31st, 2019, but the policy doesn't go into effect, excuse me, until the next day. When we got that money, we debited cash and credited unearned revenue, okay? Then we're going to record the revenue as we provide the insurance coverage. I'm going to have one quick comment here. Unearned revenue is the reciprocal of a prepaid expense. The cash received by the insurance company, Corey, right, is their unearned revenue. But the payment we made when we credited cash was a debit to prepaid insurance. So if you think of them that way, prepaid, unearned revenue is the same thing, depending on whose ox is being gored, okay? The revenue principle. You finally play baseball, you finally have the insurance policy in effect, then you're going to get rid of that liability with a debit and credit regular revenue. Revenue principle. This looks like a repeat, huh? Here is something real important, and this is kind of what we've been talking about. The matching principle. What are we matching? The matching principle means matching revenues and expenses. And I guarantee that'll be on the test in a form of a multiple choice question or true false somehow. The matching principle. Throughout the month, you are attempting under GAAP to match the revenues that deserve to be recognized with the expenses related to that month. In other words, you had sales of $100,000. You want to make sure that if you had any advertising done that month, you record that advertising expense that month, and maybe not when you pay it the next month. So matching means matching revenues and expenses. Matching is revenues and expenses. So here we go. The matching principle. When cash is paid on the date the expense is incurred, here we go. Again, Papa John's got the telephone bill in the mail, and the guy who runs Papa John's said, Corey, pay it right now. Write a check right now. Okay, well, you wrote the check, and when you put it into your accounting system, you debited telephone expense and you credited cash. Just means that the cash and the expense happen to occur at the same time. But more likely, when you got the electric bill or telephone bill or whatever it was, you're going to pay it later. But you still have to recognize that expense. You are matching that expense to whatever the sales were that month, right? And you are crediting the liability called accounts payable. And when you pay the bill, you're going to debit the liability and credit cash. And here we go with the unearned stuff again, okay? Unearned, but now we're on the other side of the unearned. We didn't receive payment for an insurance policy. We bought an insurance policy, and we bought it. It's a prepaid expense. It's a prepaid insurance expense. That policy we bought December 19 does not go into effect until 2020. We bought it on New Year's Eve, and it was our bad luck that our factory burned down 10 minutes later. We don't have insurance. Bad timing, huh? But the next day, January 1st, we do have insurance. And if we had that unfortunate event, we'd be covered. So if we bought an insurance policy for $12,000, we have to be smart enough to record $1,000 worth of insurance expense each month, until we use up this asset. And I am getting a little bit ahead with that, okay? When the expense is incurred, prepaid is reduced and expense is recorded. We had a policy for $12,000 in January. We're going to debit the expense and we're going to credit the prepaid. Prepaid, remember, prepaid expense is an asset, as confusing as that might seem. Prepaids are assets. Excuse me. The matching principle. Matching principle. Supplies inventory. That is an asset. There's no expense until you use the supplies. Same thing with the insurance. No expense until you actually have insurance coverage. Buildings and equipment, no expense until you begin depreciating. Here is a good look at your T accounts. Take a look at your debits and credits. Assets have a debit balance. Therefore, liabilities and capital have to have a credit balance. Okay? So assets have a normal debit balance, liabilities and capital credit. Now let's see how revenues and expenses are handled. Look at this now, please. Retained earnings is a part of equity. We know that, right? Retained earnings is part of equity, along with contributed capital. So, of course, equity has a credit balance. We should know that from the prior slide here. Assets or debits or liabilities and equity, all components are credits. So please take a look at the bottom here, revenues and expenses. Revenues are increased with a credit. Expenses are increased with a debit, okay? After eating dinner, let's read comics. After eating dinner, let's read comics. Why don't you write that down if you like these types of mnemonics to help you remember? I got that from Professor Reyes. I never heard that one. After eating dinner, assets, expenses, drawing. We don't have drawing in this business here. After eating dinner, liabilities. Let's read revenues. C is capital. Okay. After eating dividends, we'll use the word dividends there. Okay. So you guys are going to struggle a little bit. I mean, we have about a half a dozen people or so here. Well, it's actually grown a little bit. We've got people here, you know, you're seeing this is the first time when your buddies see this video later or they're working through the book, you're all going to be fighting through what's a debit, what's a credit in terms of the balances. Now here we go. This is what I said. We're going to get into the guts here, the innards. And excuse me, let me get a shot of whiskey here. Who's that ugly stuff, huh? Okay. Papa John's sold pizza. How about that? Who knew? For $36,000 cash. And they sold supplies to the restaurants. You know, they make them pay for their pepperoni. And they received $21,000 in cash with the rest due on account. Oh, that's complicated. So let's divide and conquer here. What happened? They received cash of $36,000. We know that is going to debit cash. And we know they sold supplies. They got 21 in cash. So let's see what we're talking about here. This is more of how to think about the transaction. I think we're beyond that with you guys. So let's see what we have here. They sold pizza for 36 and they sold supplies that generated 21. 57,000, right? Cash went up 57,000. The amount they sold the amount of revenues they received is $66,000. That's the 36 plus the 30. The difference between the 30 and 21 represents accounts receivable. Accounts receivable. Anybody have any questions so far? I will continue. What do you think, Corey? I can see Corey there. You okay?
Yeah, why is 30,000 in supplies counting as sales revenue?
Because that's a good question. When they sell supplies to the franchises, that's revenue for Papa John's from the franchise.
Okay.
There, you open up, you want to be a franchisee of Papa John's. You have to pay them like $1 million. I mean, it's expensive to get started, but you also have to purchase from Papa John's your ingredients. You can't go to a third party for that. So as far as Papa John's is concerned, that's, you're just another customer for purposes of this. That's a great question. So here we go. They're kind of explaining what the stuff is. They sold pizza for 30, blah, 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 same exact thing. Cost of the dough, cheese. We're back on that. Now, here we go. This is interesting. Look at this. When they sold this pizza, the supplies, the ingredients that were on those pizzas cost $30,000. That means that they had sales for pizza of whatever that number was earlier, 57, I guess, and the ingredients on those pizzas totaled 30,000. So you have to debit cost of goods sold, which is the cost of the ingredients in the pizza, and you have to take that out of your inventory. That's where the pepperoni and the salami and the cheese were. It was sitting in your inventory. Every sale will have a sale and a cost of goods sold element, and we're really going to get heavy into that, okay? Papa John's sold new franchises for 400 cash, and then they did some work for the franchises. The rest are going to be earned later. Let's take a look here. What happened? They sold franchisees some stuff for 400, and they did some work on their behalf. You know what this could be? Advertising. Papa John says, okay, each one of my restaurants has to pay me $400 in advance for each month for advertising. And this month I did $100 worth of advertising, so that's revenue. And the 300 is advertising we've not yet done, but we've been paid for it in advance. Whoa, look at this page now, huh? Obviously, there were a lot more transactions that were done during this fiscal period, whatever it was, a month or year, for Papa John's. We just went over the first 4 or 5, okay? In your book, you will see all of the transactions. So all of the transactions have now been recorded in your journals, and you hit the button that says post, and here's the result of posting. You have a beginning balance of cash of 13,000, and then they received 50,000, then they spent 7. The ending balance of cash is how much? Can you read that number? $41,900, right? How did we get that number? The answer is you add the columns and the high man wins. In other words, you had 13,000 at the beginning. You received 57,000. Your cash balance at that point would have been $70,000. But then you spent 7 and went down to 63, et cetera, et cetera. So when you're getting the balance of a T account, you're going to add the debit column, add the credit column, and the higher number is the balance. So cash should have a debit balance. It's an asset. Look at your other assets they're giving you here. They're giving you prepaid expenses. That's an asset. Debit balance. Accounts receivable, prepaid supplies, property and equipment. They are assets. Look at your liabilities. You have two of them here. Accounts payable has a credit balance of 39 and your unearned revenues. The unearned revenues, you don't owe anybody money. The whole point is you've already been paid in advance. You owe insurance. You owe a concert or something. Magazine subscriptions is a good example of prepaid revenue. Take a look at your two revenue sides pieces here. Excuse me. Restaurant sales, they had 66,000 in sales. They got some revenue from their franchisors, I guess, and they had some gains that were offbeat. We don't know what they are. They didn't go over it. And they had some investment income. They loaned money. They loaned somebody X amount of dollars, and it came out to $1,000 interest. Cost of goods sold, say hello to your sauces and stuff. They had to pay salaries, and they had to pay a whole ton of other expenses. So at the end of the period, you're going to see your general ledger look almost exactly like this. Here are your ending balances. Once we have that, we're ready to prepare the financial statements. So let's see how far this chapter goes. A little repeat here. Revenues minus expenses equal net income. That's your income statement. Must be done first. Why must it be done first? Because we need to get the income in order to increase the beginning retained earnings balance. And if they issued dividends, declared dividends, let me say it properly, that will reduce your equity because they've given away part of the company. And that will give you your retained earnings. Beginning, income, dividend, ending, bide. You can bide your time. You ever hear that expression? Bide your time, B-I-D-E. Beginning, retained earnings, plus income, minus dividend, bide, ending. Some students like that kind of stuff, others don't. I'll tell you a quick aside. When I took the CPA exam way back many years ago in Los Angeles, I took the Becker CPA review, without which I could have never passed the test. And that course was filled with mnemonics that I remember over 45 years later. I still remember Fibonacci, Tipsy-Wacky, Fibonhouse. They were very helpful to me. Others students didn't even write them down. They were, just different strokes for different folks, huh? And now that you have the ending retained earnings, you know that's going to go into your balance sheet, huh? That's the flow. Statement of cash flows we don't care about. We don't care about flow. She's on television, right? Progressive Insurance, very annoying. Anyway, how are financial sheets prepared? Here's a little grid. You do the income statement first to get the net income to bring it over here, to get the ending retained earnings to bring it to the balance sheet. Okay? You cannot do them in sequence. I remember when I first started with a company, trying to be helpful at the end of the month, I said to the boss, okay, boss, I'll do the balance sheet while you do the income statement. And he said, okay, get started there, Bob, knowing I was going to run to that roadblock that I can't finish the balance sheet till we did the income statement. That's how you learn, huh? The income statement. This is kind of an interesting thing. Normally, accounts with zero balance are not included. However, we include them here to indicate there were other expenses, huh? Yeah, I think that's true. You don't usually see zeros on a financial statement. The only time you'll see zeros if there are comparative statements. In other words, this is for the year ended 09. Maybe they have another column here for the year ended 08. And in that year, they might have had $50,000 in supplies, and you have to show the zero to show the difference between the two. That's an interesting note. Statement of stockholders' equity. Take a look at this. This is the first time you're really seeing a good presentation, I think. Look at what we have here. Statement of equity. You have a beginning balance of equity of 130. 130. At the beginning of January, in other words, the ending of December, your total equity was 130. It consisted of $7,000 that Papa John raised with a stock issue. Then they made profits over the years that totaled $123,000, assuming no dividends. If there were dividends, okay, still 123. Here they issued more stock, so contributed capital goes up. Contributed capital has nothing to do with retained earnings, because retained earnings retains the income of the business over the years. It retains the dividends. That's why the income and the dividends are part of retained earnings, not contributed capital. If you misclassified the numbers, you'd still come back to the total correct, but you'd be totally misrepresenting what really happened. And your investors could make a foolish or good decision based on that, okay? The net income comes from the income statement. And I'm also going to go back to the income statement real quick to remind you of something you should already know. Notice that it says income statement for the month ended. You have to say for the month ended or the month of, because the income statement is a cumulative item. It is the revenues from day one added to the revenues to day two, to day three, etc. So it truly covers the entire month. Same thing with these numbers here, okay? You okay with the equity statement, Maria? So far, so good? Okay. Maria's quiet. Okay. Now that we've prepared that statement, here we go. The balance sheet. Notice this heading. It doesn't say for the month of. If it did say for the month of, it would be wrong. The balance sheet is not an accumulated number. Cash didn't start with zero and then went up and up and up. It went up and down, up and down. Everything in your balance sheet goes up and down. So the balance sheet must say, as of December 31st, at like it says here, January 31st. This is a snapshot. This is a photograph. This is how much cash you had in the, sorry about that. This is how much cash you had in the bank at the end of the month, $41,900. Customers owed you $20,200 at that exact point in time, at 11:59.999 at the end of the year, okay? Notice they break them out into current assets and current liabilities. Current assets, you're going to learn, are assets that are going to be used within probably the accounting cycle, okay, within a year. And current liabilities, same thing, things that are going to be paid within a year. Otherwise, they're not current assets. And that's an important measurement for later. Cash flows, we're not going to worry about this because you have a lovely chapter 12 when we come to preparing this lengthy cash flow statement. Just remember, operating from selling pizza, investing, you bought equipment, or you bought stock in another company, financing, you borrowed money, or you issued stock. Here's another ratio. Revenue divided by total average assets. These averages are the beginning balance plus the ending balance divided by 2. We'll go over this more in the next week or so. and especially when you get into the FSA. I did not remember to see when the FSAs are going to be assigned. It'll probably be in about a week or so. You're going to do about 5 of them during the course. And I hope you find the FSAs interesting. Once you do them for 2 companies, you're going to know quite a lot about those companies. And if you see them mentioned on the news, you can turn to your wife or husband or whatever and say, hey, I knew that. Well, here's the turnover calculation. For every asset this company has, for every asset Papa John's has, they're generating $2.87 in sales. And then you go and you buy sailboats, okay? So that takes us to the end. We've been here, what, about an hour now? A little over an hour. So I think we had a pretty good session. I'd like to hear from each of you with a comment or tell me you're okay. You're okay, Marie? You have questions?
I think I'm okay for now.
So far, so good, huh?
Yes.
Okay. Anybody else? Nobody? Hi, Justin.
This is really hard. I got to tell you, this is, but
I have a feeling you did not take 110. Is that correct?
actually, I'm embarrassed to say I did take 110. So the concepts, I mean, I understand it, but this class seems to be so much more of a jump.
It is quite a leap. Well, that's okay. I mean, I kid the kids with the one. Some of the students who took 110 and did great, they come into this, Justin, and they say, "Oh, this is gonna be a breeze." No, when we hit, So
and I got an A in 110, but man, I don't know about this class.
you weren't in my 110 class, were you, Justin?
No.
Can I ask who your teacher was?
The same teacher. Spacing on her name.
That's okay.
Yeah.
Who was it?
So, who the name? I am so bad right
okay,
now.
that's fine. That's no fun.
No, our head teacher now. It was my teacher.
Cornelia.
Oh yeah, Cornelia. No,
Yeah,
Cornelia's real
sorry.
good.
Yeah,
But what
yeah.
you're experiencing, Justin, is not unusual. I would suggest, if you like, the way I babble these things out, join me for my tutoring hours.
Right.
Alan's here for that. Alan's for tutoring.
Yeah.
But are you good
But I
with the
need
debits
to.
and credits?
One more time.
Are you good with the debits and credits? Or you still
Yes, very good with that. I mean, that's
Okay.
locked in.
There you go. Okay, so
Yeah.
you're ahead of the game right now, whether you realize it or not. We just covered quite a lot. This is what, the second
Right.
week of this class, and we've gone through 3 chapters already.
Yeah.
And this class does move rather quickly. So, but you keep up with the homework. You keep in contact with me, the tutors.
Right.
Like I said, I gave out my text number, private email. You can always get a hold of me if you're stuck on homework.
Thank
We
you.
want you to succeed. And it's
Yeah.
especially difficult when, we're sitting, you could be in Australia for all I know,
Right.
not face to face. Okay, you hang in there, Justin.
Thank
Who
you.
else is with us here? Who else? Anybody else want to say hello? People are ducking Maria. We chatted with Maria. Anybody else? I guess not. Okay, with that, I will ask one more time. Any questions, comments, concerns? Going once, going twice. And I'm going to let you know something that's very important. The New York Jets not only stink, they could possibly be the worst team in the history of the National Football League. They are horrible. And they're playing the Denver Broncos, who are real bad, tomorrow on television. And the joke in New York is neither team is going to win this game. So we'll see. Okay, you guys take care now, okay?
Thank you, Professor.
Thank you.
Bye-bye.
Bye.